Good afternoon, everyone, and thank you very much for taking time out of what I'm sure are very busy days to join us. Welcome to Uncleared and Present Danger. It's a Riskworx presentation on the impact of derivatives margining changes in a South African context. Our speakers today are Jill Rain, Anthony Mileta, and Ved Somera. Jill has an enviable career in banking, most recently with the First Rand Group, where she managed new issuances of capital instruments marketed to a global investor base. She was involved in a number of high-profile infrastructure transactions, including the N1 and N3 toll roads, and was involved in structuring and arranging the first inflation-linked debt for the N1 toll road. She is currently a senior policy advisor at ISDA, chairing the Standing Committee on Fixed Income, and is a member of the Financial Markets Review Committee, the South African FX Committee, and the Market Practices Group. Ved is currently the head of collateral trading at Nedbank after an illustrious career in the South African equities market that included stints at both Deutsche Bank and Credit Suisse. Anthony Mileta is a lead consultant at Riskworx and has truly broad experience in enterprise risk, having worked across credit, market, and ops risk in both the global markets and retail clusters, and with experience most recently in unpacking the reference rate reforms in a South African context. For those of you who don't know me, I'm Ashley Cantor. I'm currently head of Risk Lab at Riskworx and have been with the organization for 16 years, focusing primarily on market risk, but with experience in most of the places in a global markets context touched by risk and quantitative pricing. When we originally decided to do this webinar, I'd been working on a SIMM implementation for a client. While the calculations themselves are interesting, it's largely a prescribed framework, and there's a wealth of information online to decode what's required for a successful implementation. As we started to think about what other aspects of the problem might be of interest, one thing really stood out, and that's this question of the rising importance of repo. The SOFA surge of September 2019 is something that's of significant personal interest to me, and the importance of repo and non-cash collateral, given the coming margin requirements, clearly add to what's already an interesting dynamic. So when we approached Jill and Ved about their involvement, for me, given that Riskworx is so often numbers focused, it was really interesting to hear their perspectives and understand the market dynamics at play. They've both brought a wealth of knowledge to the table and are both clearly passionate about the topic. So I hope our attendees can get as much out of the webinar as I personally have. Just a quick administrative matter. We are running some polls on Slido. You can click on the QR code in the top right-hand side of the presentation, or we will also be posting a link to Slido that you can use to click through and respond to the existing polls, and also post some of your questions for the end of the presentation. And yeah, so without further delay, over to you, Anthony.
Thank you very much, Ashley, for the introduction, and thank you everyone for joining us. We hope that everyone has been safe during this difficult time. My presentation is meant to be long. I'm known to have many words, but I will try to be as brief as I possibly can and to the point. So I have, for my presentation, I'm going to be covering few themes, such as the background to ISDA SIMM, the mechanics around ISDA SIMM, margining, as well as collateral. And I think without any further ado, we can kickstart to the next slide. Some years ago, Warren Buffett once said that derivatives are weapons of financial mass destruction. And this was because of the role that they played during the financial crisis of 2007, 2008, that saw the likes of Lehman Brothers filing for bankruptcy. And of course, the regulation that ensued that, including the Basel III regulation, both capital to strengthen capital requirements as well as liquidity requirements. However, there was also a need by regulators to regulate the derivatives market by increasing the collateral within the market so as to reduce the exposure to credit risk, as well as leveling the playing field, as you will, between OTC derivatives and non-cleared derivatives, as well as cleared derivatives. And yeah, so this particular slide speaks to the genesis of how these OTC reforms came about. And we shall see further down the line the mechanics of it, as well as some of the intricacies around it. Can we move to the next slide, please? So in the world of collateral, there are two kinds of collateral. There is what is known as variation margin, which is essentially mark-to-market of a position throughout time. And there is what we're really interested in, which is initial margin, which is an additional amount that one will have to compensate if there is a default by a counterparty or during that time between the default and the closeout. And really, if you think about Lehman Brothers, I was reading somewhere the other day, I think it was Lehman in London, that despite their massive exposure to derivatives, but because there was I think London clearing house, it didn't take them too long for them to pay out some of their claims. And that speaks to that margin period of risk, which is the gap between a default and a closeout. Next slide, please. The mechanics for ISDA SIMM is quite simple. There is what is called a custodian, which is an unaffiliated party, and there is an initial margin agreement within which the collateral rehypothecation will be dictated, as well as the haircut for collateral and the eligibility for collateral. So in an actual sense, this custodian, it may be one or two, is responsible for collecting collateral and managing collateral and defining some of the terms therein. Next slide, please. So where we are in the implementation of the project is for the last, I think, 3 years before the COVID pandemic, internationally, phases 1 to 4 firms have already been implemented. And now in South Africa, early this year, we are looking at phases 5 company with a threshold of 15 trillion rand and phases 6 company later during the year, which for me, it is quite interesting because it begs the question, are we ready for this? Is the financial market in South Africa ready for this implementation? And what are some of the challenges that we are going to encounter further down the road? Next slide, please. Now, really breaking down and speaking about what is in scope for the project. And we have summarized it by saying that there are two kinds of contract you may have. You may have a CSA contract, which is a perfect CSA contract that's collateralized. And you may have a no CSA contract, in which case there will be some kind of a charge, a CVA charge that a counterparty will have to pay. For this particular context, with the SIMM ISDA reforms, we are really interested in the instances where there's a CSA involved. Next slide, please. Next slide. Hello, can Mr. Phillips, can we move the next slide?
I'm sorry, I have breaking connectivity. Apologies.
That's okay. For in-scope products, all interest rate derivatives products are in scope, and this includes all interest rate derivatives, credit derivatives, FX derivatives in all three jurisdictions, Europe, South Africa, and the US, with few that are exempted. This includes physically settled FX options, physically settled FX swaps, and equity options. They're in scope for Europe starting from this year, and there is a bit of, we're not clear where the US is at this point, but they are also in scope in South Africa. And of course, all these instruments that are governed by the MIT regulation in Europe are in scope, and the CFTC in the US. So essentially, from this slide, it's quite clear that most instruments are in scope for the regulation. Next slide. Here we have classified the derivatives market into three. One being exchanged, other one being OTC cleared and bilateral, and this is just to give a view of the different methodologies that are used in calculating initial margin, as well as some of the sort of the recalibration method. It's quite clear there that for this ISDA SIMM, that margin period of risk is 10 days for obvious reason, which is 10 times more than what it is for the exchange. Yeah, can we move to the next slide, please? And lastly, I'm going to cover quite briefly on the global derivatives market, as well as collateralization and the demand thereof. Globally, I think the global derivative market, 90% of it is over the counter, with the remaining 9% being exchanged. And of the 91% that are over the counter, 60% is bilateral, and 40% is centrally cleared. And so the bit that we're really interested in for this project is the 60% that is bilateral, and also the remaining 20% that is not collateralized. And it is quite clear, quite obvious that this is going to be, the implication thereof of ISDA SIMMs are going to be quite far-reaching, given the 20% of the market is still, not collateralized. Next slide, please. Back home, our market, the bulk of it, 96% or so, is over-the-counter derivatives, of which the bulk is interest rate derivatives, forward rate agreements, and interest rate swaps. And according to the report that was written by PwC some years ago, 85% of all our OTC derivatives are interest rate derivatives, and which is quite significant, and the remaining 3 trillion or so is foreign exchange derivatives. And it is quite interesting because it will mean that, again, when we have to ask a question, are we ready for this? Do we have enough capacity for this? Because it seems like a huge portion of our market is OTC derivatives market. Next slide, please. Eligibility for collateral. Collateral is, in this context, is an important one. It is important because these reforms are really all about collateral. They are really about collateral, the kind of collateral that you pledge, and the demand thereof. So globally, right now, the split between initial margin collateral as well as variation margin is that 16% pledged is initial margin, 84% is variation margin. And of the initial margin that is posted, about 16% of it is cash, and the remaining 84% is government securities. Whereas the VM is the government security. The government securities actually make the bulk of it as well, and 11% is cash. It is quite clear from this that these high liquid assets are most preferred form of collateral. And when we speak of these reforms, particularly the eligibility of collateral that will be required to be posted. High liquid assets are mostly preferred over cash for various number of reasons, one of which being that if a collateral is posted with a custodian, and a custodian could be a bank, could be any third party, and that custodian were to default on its obligation. If it's cash, the creditors might want to have a claim on it. But if it's a security that is registered and ring fenced, then they might not have. They won't have that. It will go back to whoever the counterparties are. Next slide. So this what drives the supply and demand for collateral, the economics for collateral. We've said there are two main drivers for the economics of collateral, changes in demand versus changes in supply. And there are structural sources as well as cyclical sources. And cyclical sources, these are mostly stress sources. They are quite reactionary. Of this, I'll mention one or two of them. The changes in regulation, Basel III, for instance, that actually requires banks to increase their capital requirement as well as liquidity requirement. That has led into a demand for high liquid collateral. But on the other hand, because we have broadened what that eligibility of collateral means, things that previously were not eligible to be higher liquid collateral are now classified as high liquid collateral. That has actually led to a more supply for collateral. And of course, this reform, the very same project that we're talking about now, that requires more collateral to be posted, initial margin, that will lead into a more demand for collateral. But we've said, due to the fact that collateral may not re-hypothecated or may not be reused, that will lead into a less supply of collateral. And of course, cyclical sources that increase in credit risk. When credit risk goes high or perceived credit risk, the demand for collateral will go high. If the sovereign risk is deemed to be there, the bonds, government bonds that people have are downgraded. They may not be used, leading to a lessened supply of collateral. Next slide. And lastly, this is to summarize the global demand for collateral. And there are various ways of calculating what that demand should be in the marketplace. And one way is what the International Monetary Fund have done. They've taken your credit exposure versus what is reported. And it is quite clear, if you look at the blue versus the green, that the need is always been very high, and with more and more derivatives moving, or bilateral derivatives moving into CCPs, being cleared, centrally cleared, it is quite clear that the need for collateral will continue to rise. If you look at the diagram on your right, twice as much. So in conclusion, the demand for collateral and the need for collateral due to this OTC reform are going to increase. And that has far-reaching implications on companies in terms of how they manage their collateral, in terms of how they're going to raise their collateral, in terms of how they're going to optimize their collateral, and in terms of how they're going to transform their collateral. With that background in mind, I hand over to Ashley, who's going to be taking us through some interesting concepts.
Thanks a lot, Tony. Yeah. Yeah, I mean, I think that really is the heart of the matter, is this increased demand for collateral. I think the dynamics around the liquidity coverage ratio and the need for HQLA is just a really interesting dynamic. Just one small matter, we will be updating the poll, so please check in for a new poll, and please also do post your questions on Slido as we go through. So this slide is the anatomy of the SIMM calculation. For those of you familiar with it, it's really quite similar to the sensitivities-based method for FRTB. You start with your standard sensitivities, delta, vega, curvature, to your usual group of risk factors, your interest rates, credit, equity, commodities, FX. These are then signed risk weights and aggregated via a variance-covariance approach to produce a margin amount per risk class and product class at a portfolio level. And I mean, one of the first things to note is that this is reasonably complex, complex enough that even sophisticated players have had challenges with reconciliation and disputes around the calculations. And I don't know if any of you have followed the ISDA webinar series related to that, but it is interesting to hear some of the international players talk about the challenges that they've had. And I would encourage any of you who are ISDA members to download the Collateral Management Transformation Toolkit to learn a little bit more about the process. If we can just go to the next slide. Okay. So there's some interesting structural elements to the calculation. So SIMM is symmetric. So one of the interesting upsides of that is you could end up paying margin on a bought option, which is one of those things that's maybe a bit counterintuitive. Now, since it's intended to operate on a portfolio and you'd only really exchange above a threshold, it's unlikely that you'd exchange margin on a single option position. But it is worth noting that SIMM and CCP-IM have different dynamics, and this means there are opportunities to optimize margin posted through effective use of CCPs as well as SIMM margining agreements. So here we have a comparison, if you just want to move through to the next slide. So this is a comparison of margin calculated for SIMM across multiple counterparties. So that's effectively the scenario 2 that we're looking at against a multilateral J-span calculation, which clearly shows the benefits of handling trades on a multilateral basis. But there are a lot of moving pieces here. So, I mean, one of the things that's worth noting from a SIMM perspective is obviously there's a threshold for margin exchange that's in place, meaning you could manage a reasonable level of exposure against a specific counterparty without ever actually exchanging IM. So from this perspective, it introduces some interesting dynamics for collateral optimization from an exposure perspective when you're managing these exposures across counterparties and exchanges. And I think it creates an interesting ecosystem in terms of the venues against which you can actually manage your IM exposure. Next slide. Okay. And with that, I'm going to hand over to Jill to give us the buy-side perspective.
Thanks, Ashley, and good afternoon, everybody. Okay, so I'm going to briefly talk to 3 interconnectivities in the market: repo, OTC derivatives, and JIBAR reform. And I think, you know, a theme across all these changes is we are dealing with historical bifurcation. So if we can go to the next slide, I can try and explain. So if we start with joint standards on margining for OTC derivatives, I mean, the first paper on reducing risks in OTC derivatives in South Africa came out in 2012. And, you know, the phases envisaged were central clearing, central trading, and standardization. And then only the third phase was risk management, so margin and increased capital requirements for non-centrally cleared derivatives. So, we only got the Financial Sector Regulation Act in 2017. So, there was segregation between what was being discussed at what was in the FSB and what the Reserve Bank was discussing. And I think some confusion arose in 2016 when BSD came out with the draft directive on margin requirements. Because at that stage, the buy side was of the opinion that margin would not apply to them. But clearly that changed following FSRA. And so, when the 2018 papers came out, suddenly there was a run for cover by the buy side, realizing that yes, IM probably wasn't going to be an issue because of the size of the exposure, but certainly VM was. Yeah, so if we then, so that was a bifurcation between the FSB and the SARB, which has now obviously been dealt with, that we now have joint standards that are published under FSCA and the Prudential Authority, or SARB. So that has been dealt with, but there's a legacy sitting there that the buy side's really not ready. Then the second part of the concern we have is, obviously we need a lot of collateral, as Tony's intimated. Now, our repo market, that's also been bifurcated. If you go back to the 80s, we had a money market that did classic repos, and that was largely with the discount houses. I mean, sorry, this sounds like days of yore, but it is. And then in the bond market, we had scrip lending, covering of shorts, and we used buy-sell backs, but not necessarily as a way of securing funding. There was a segregation between bonds, which was, capital market funding, and the money market, which was short-term liquidity management. And that has resulted in basically this legacy where our repo market is largely buy-sell backs rather than classic repos. So the only classic repos are done between the banks and the central bank for part of the management of liquidity at the window. And we've also ended up with a situation where, the JSE requires all transactions in listed instruments performed to be booked through Neutron. And Neutron battles to deal with haircuts and also with daily margining. So most of our buy-sell backs are done without margin and often without haircuts, which means that we don't really have a secured market except when it's done by way of by classic repo. Now, the fact that we don't have sort of a liquid repo market means that, when it comes to the third block, IBOR reform, the future of JIBOR in South Africa, we don't have a general collateral rate at this stage because of some interconnectivity problems, the rate on individual bonds can be distorted by the inability to move the collateral from the SARB collateral management system into straight. So, there are some inefficiencies that need to be dealt with. And in order to have a secured rate, we have to, fix these issues in the repo market. So it's all interconnected. We need a secured rate in order to use that for calculations in the secured market. We need more collateral in order to meet the OTC derivative margin. At the moment, it's cash, and that's got big problems with the buy side because of interconnectivity and concentration in the banking sector. And at the same time, our repo market is not working the way it should be. So let's unpack that a bit more. Anthony, next slide, please. Okay, so we all know what the repo market does. But as I've said, you know, the way we're looking at the repo in this context is very different from the historical bond type repo that has been taking place since the 80s using buy sellbacks, which is really just a way of more covering shorts, and in some instances using it as a way for banks to fund their market making books. But you know, the thrust was really securities and not cash. And I think we're now in a situation where the focus is now on collateralization in order to deal with credit counterparty risk. And that's where the initiatives that are now taking place. So under the Financial Markets Liaison Group, there's a task team there's a task team that's been established to deal with collateral and clearing, to deal with these issues, starting with a collateralized interbank market because of large exposure Basel requirements coming in, that we need to move to a collateralized interbank market. And it needs to go further because of the large exposure that the buy side has to the banking sector. You know, even now, before we get involved with more collateral through OTC derivatives, the exposure that the non-bank financial institutions have to the 5 big banks and mainly the 4 big banks, I mean, it's over R1 trillion. It's large. You know, so this anatomy of the repo market, we need to deal with the detail. It's all in the detail. It's the regulations, it's the market infrastructure, and it's what I call the plumbing. So if we go to the next slide, please. So if we start looking at basically the infrastructure, the regulations, and the plumbing, I've already indicated some of the problems with Neutron. You know, the JSE was working on introducing MTS repo, which works very effectively in other jurisdictions, but that's been put on hold. There are issues with certain sections of the Financial Markets Act, which create some dislocation that unless you're acting as principal, you need to report through Neutron. So that, you know, the Straight is in a position to run tri-party collateral management, but that's completely separate from the way the market actually books the trade. They're just doing the collateral management in the background. So the key things we need to sort out is the infrastructure and some of the confusions that surround JIMRA. JIMRA by its nature is a title transfer contract. And we work in title transfer in South Africa, but unfortunately that has given rise to some concerns about title transfer in the legal sense and accounting derecognition and all the consequential accounting and tax rules. So, you know, they do cause some confusion. So moving on to the next slide. We don't have a trade repository in South Africa. We don't have central reporting. The only CCP we have is JSE Clear for the listed derivatives. And this is a major problem. If we try and implement what effectively is phase 3 without having the central clearing and central trading capability. And this is a particular problem for the buy side. So let's go there. Next slide, please. So when it comes to the buy side, where there's no CCP, there are no netting benefits. And I'm not talking only about netting across products. I'm talking about netting across funds. Because remember, that a lot of pension funds and even some life portfolios are multi-managed. So you might have, one asset manager managing a portion of a fund and another asset manager managing another portion. And there's no way without a CCP of netting any positions across a particular LEI, because there's no central depository or central no depository where you can actually see the positions of a particular LEI, because they are, with bilateral, they're managed separately by the individual asset managers. And I mean, that is a big problem because of the nature of the way our funds are managed. The operational issues, well, unfortunately, the SIMM calculation and all the requirements for that, apart from the life companies, the big life companies with the long-dated guaranteed annuity books, are not set up to do this. So that's a problem. At the moment, as I've indicated, only cash is accepted, and we need to sort out the FISLAB, the Insolvency Act, to deal with that. And individual asset managers also have valuation issues because, collateral posted with different banks earns different rates. And it becomes extremely complex where you're managing segregated funds. You might have an asset manager who puts a trade on in, 100 million in swaps. But if he's got 25 clients, he needs to manage any variation margin 25 times with 5 banks across 25 clients. It's logistically, it's very complex without a CCP. So if I just look at the circle of life, starting with life companies, I think the life companies, the large life companies, they have the systems and they are in a position to manage this to a large extent. There has been a proposal in the regulations to exempt retirement funds, but that's not so simple, because our retirement funds largely are not standalone funds, except some of the large public pension funds. A lot of them are managed as umbrella funds under a life license, and a lot of them use CISCA funds as building blocks. So once again, it's very complex to identify the ultimate pension fund, LEI called pension fund, because the funds are actually deployed under different building blocks. And so there's complexity that we need to work through there. There's no threshold in South Africa for variation margin, irrespective of volumes of trade. So, in Hong Kong and some other jurisdictions, Canada, Australia, there is a trading threshold, but we don't have that at this point in South Africa. We all know that CVA charges are coming in 2023, and it's not clear what that means for the current practice of providing some sort of relief for margining using one-year break clauses to minimize CVA charges. That's something that needs to be worked through. And then the last, number 5, was what I started with, the lack of netting benefits because you can't net across a particular LEI. So what does this mean for the buy side? Anthony, next one, please. So the buy side view of this is that the regulations really aren't fit for purpose for the non-systemic exposures of non-bank financial institutions. Some of the positions are relatively small, and yes, I know there are minimum transfer amounts and those things, but it does still mean that every single party either needs to develop the in-house ability to do the calculations or contract with a party to do it on their behalf. And this is work in progress. As I've said, life companies are possibly able to comply. If asset managers need to implement this bilateral operating framework in-house or through a service provider, there are going to be additional costs. And, you know, one of the risks on the far left, being number 4, is that, you know, in the current transactional environment without a CCP, the operational complexities of managing segregated funds across bilateral contracts with 5 banks, no, not 5, more than that, and posting cash collateral margin becomes a logistical nightmare. And there's a risk that the buy side may withdraw from the market. So that's not I mean, it's just an operational complexity that means that it's very difficult to transact in these markets. Yeah, so that's the buy side version. And, you know, I'd be delighted if people can find a solution. And yeah, that's what we're really here for. So I'm not going to talk to legislation. Ash, so it's back to you.
Okay, great. Thanks. Yeah, so just an update. The Slido Q&A is still open, so please do continue to post your questions there. So this is just the kind of typical anatomy of some of the adjustments associated with the trade. And obviously, we're looking at margin covering the variation in value of the portfolio between the current date and closeout on default. And then obviously, you've potentially got CVA on unmargined trades that you're carrying over the life of the trade. If you want to go to the next slide, please. So I was going to ask Dino not to check my maths, but now I also need to ask Pietro not to check my maths. So we're just going through a very, very rough CVA calculation for a sample trade. So looking at a 20-year swap, 250 million Rand nominal. And just having a look at an indicative CVA number on that trade. And the purposes of this is really just to have a reference point. So when we go to the next page, and if you could just go to the next slide, this is looking at kind of the relevant MVA charge. But then there's also a more important detail that we're looking at here. So again, caveats that MVA calculation is very rough. And we're just looking at that across a number of different types of collateral. And it's not kind of strictly relevant in, let's say, the SA government bond context, because there you would be looking at your return via repo. But I mean, we're just looking at to get an indicative level around the MVA. And then the important thing, I think, to look at, and this is talking a little bit to the buy side perspective, more importantly, is the return that you would potentially earn holding the specific collateral as part of your asset mix. And I think this is one of the important points, particularly in the buy side context, is having to shift or having to regularly hold cash over securities. You potentially have kind of a 2 million difference in terms of the return that you can actually earn on that position over the life of holding that as part of your asset mix. So I think that's where things start to get a little bit interesting is, you know, obviously it becomes that much more important from a liquidity management to have the right mix available. So to avoid too much switching out between securities and cash on a regular basis, and also to have some sort of capacity to regularly hold a significant amount of government bonds and securities as part of that collateral mix. And with that, I'll hand over to the experts on this matter. Ved, if you just want to take us through the technical collateral management function.
Thank you, Ashley, and good afternoon to everybody. Thank you, Jill, for your words from the buy side. I think in terms of the challenges seen on the buy side, it's very, very similar on the bank side, but there's also a more complexities which I'll deal with. So there will be some replication or duplication of stuff mentioned by Jill. Just one of the things I want to mention with this new regulation, what's very interesting is some of the work has said swap dealers or sort of banks are obliged to institute these sort of margin detail. The important thing is that it says nothing for the buy side, but by the virtue of buy side dealing with swap dealers or the financial institution called banks, they then pretty much will be forced to be part of the same regulation as well. So I think it's a very interesting space we are in from a global point to where we are in South Africa. Joel touched on it quite nicely in terms of how there's this move in regulation. So we've got the SIMM change that's going to happen very shortly. We've got the large exposure, which is coming in on the 1st of April, which is actually very big as well for the market. There's a few other sort of regulations coming through, but we're not seeing the market reform required for this from a local point of view. Again, as Jill mentioned, we do not have a repo market per se. All we have, even from a banking point of view, is this repo market. So yes, it is a bit more than a stock loan transaction. There is, it is a bit of a cash management engine, but again, all transactions are done on a buy-sell back basis. And buy-sell backs are also very outdated. We are the last two countries in the world to actually be using the buy-sell back mechanism versus the classic repo. The challenge that we have with that is also with regards to legacy regulation in terms of the reporting of collateral in terms of this repo transaction. In the current form, all sort of buy-sell back transactions need to go through the JSE, despite them being OTC on a GIMRA basis. And this has come from the SARB, who sort of need to look at the flow of SA assets within the country. But saying that, at the same time, we've got the same asset that trades on a classic repo, the SAGBs, on the international banks between clients and international banks on classic repos, and again, out of this buy-sell back mechanism over the JSE. So there's definitely an opportunity to move in that direction. The second thing I want to mention about the buy-sell back repo is all transactions are sort of done on a bilateral basis. So there's no sort of, again, as per Jill's comment, there's very little netting off that can happen once you are bilateral against two or three different counterparts. So if an asset manager faces three different banks, there's very, very little they can do from a margin point of view once it's set up as a bilateral. So if we had to look at, and I'm very strong about what we need to do in this market, and as people in the industry, we need to look at what the reforms of the market is. And one of the first things is we need to push the regulators in terms of moving from buy-sell back to repo markets. And what this actually means is we need to start looking at different ways of reporting trades. So again, with the lack of a CCP or a central clearing body, we kind of stuck in a place where the JSE is the only institute. So if you actually go through the reg, and I'm no legal expert, but it's kind of, it sort of says that you need to have trades reported, and the JSE at that stage was best placed to kind of deal with this. The second bit that this market kind of needs in that space is some sort of technology with regards to the repo market, and I think that naturally falls into where the global market is now is in tri-party. So I think Joel also mentioned that, but I want to give you a bit more detail in terms of the tri-party mechanism. So on a global scale, so if you look at Europe, US, and Asia, collateral is actually a commoditized trading product. It's not as we see it in this market as cash for an asset. It's actually a market where people are trading in collateral and there's a price for collateral. So a tri-party actually acts as an agent, and the likes of Euroclear, Clearstream, etc. They act as agents who kind of, number one, they look at the risk management for both the buy side and the banks. They look at eligible risk collateral that can be placed at one of the tri-party clearers. And again, what they do is on a day-to-day basis. So if you look at this change in regulation with SIMM coming in, it talks a lot about IM and how that's going to work, but VM still stays on a bilateral basis with counterparts trading versus banks. And that kind of complicates issues, I think, more than it is. But if you actually put it into some sort of tri-party mechanism, you have an agent who pretty much looks at your risk eligibility and tolerances, calculates your margin, and actually processes the cash flows on your behalf. The other bit they can take care of as well is looking at substitutions. So if you have a basket of SAGBs, for example, in our context, there can be a case where there is a short in one of the names, but you can substitute it out openly as long as you don't change the sort of credit rating on it. So that kind of makes it a lot easier, more efficient, more transparent. And I think the beauty of that as well is it applies cross-asset. This again is, I think, something for us as a market to kind of develop, where we don't look at repo and the collateral market as just being on the SAGB fixed income side, but we also start looking at commodities and equities and other sorts of collateral that we can form. So there's a whole lot of pros in terms of moving towards this tri-party model. Then I think a very important bit, and Jill sort of touched on it, but I think I spoke about this large exposure report or sort of implementation coming through from Basel on 1 April 2021. So in a nutshell, what this actually talks to is the exposure between different banks, both from an international point of view and a local bank point of view. So if you look at our current ZAR interbank clearing mechanism, so the ZAR is a closed currency. The big banks pretty much on a day-to-day basis clear against each other on an uncollateralized basis. What this is pretty much is there's no transparency in terms of what that looks like from an actual notional point of view or actual amount that is being cleared in the market. Number two, there's no form of price discovery in terms of how that actually flows through. And I think the last bit from a large exposure point of view is it's all on an uncollateralized basis. So in this Basel report, they talk about there being thresholds between banks, and I don't know those numbers at the back of my head. I need to get them researched. But this creates sort of an opportunity or creates a situation or scenario where if the likes of one of the big banks versus the other banks need to overborrow or overlend to the other, this cash needs to be put through via a trading mechanism, so pushed to the global markets of the different banks' repo functionality. And in that kind of regime or framework, it then becomes a collateralized trade where there's price discovery in terms of obviously you've got your supply demand, which gives you the pricing of your repo, and again transparency in terms of where the trades are actually flowing through. When I talk about transparency, another fact of our fixed income market, and this is not just a South African specific issue with fixed income, it is a global issue, is fixed income from a technology point of view has fallen behind our equity peers in terms of price discovery and transparency of pricing. Equities, as everyone knows, there's a quoted price. You can see the quoted price. You can see the bid offer on screen. You know exactly how that's actually trading. Whereas fixed income is trying to move into that space of some sort of market making, some sort of transparency, but the actual size and what you can do on the back of that is pretty unknown. So I think this is actually taking place in a global scale at the moment, where there is a lot of talk about looking at technology in the fixed income space, but that can also improve the sort of transparency around the repo market. The third touch point in terms of where banks, and I think on the buy side as well, require a lot of work is on the technology side. And the technology side is there's a few things that it deals with. Number one is, does any financial institution know exactly its balance sheet, inventory, and lazy assets at a single point? Are these optics available? Because that's very important from a collateral point of view. Is there any sort of situation where lazy assets are sitting on the balance sheet where it could have been placed in a better sort of form, earning some sort of yield? And banks need to look at that sort of technology. It's not very simple, because it's cross asset, it's cross business, it's cross franchises within or sub businesses within banks. So the technology in terms of developing this inventory management, it's out there. There's definitely things out there in the world and on the global scale. But from a South African point of view, I mean, the market needs to move in a case where it needs to sort of employ the use of technology in terms of driving this. And then I think that naturally talks to non-cash. And non-cash is a very, very interesting and topical point in terms of collateral management and margining, both from an IM and VM point of view. Our local market has margining pretty much all done in local currency, and we've got foreign currency against our foreigners, and then we've got the likes of our listed derivatives, where it's also all cash. The global markets have moved into the sphere of non-cash as part of their optimization strategies. And sorry, Anthony, you can actually move on to the next slide. Sorry, I forgot to mention that. So on the non-cash side of it, it gives rise, sorry, one slide further. Yeah, Ashley touched on it in his introduction, but on the non-cash side of collateral, HQL is an important part of a banking infrastructure. I mean, in terms of getting your LCR right, it all depends on how you can optimize around your HQLA and how you can fund accordingly. Sorry, excuse me. So there needs to be a sort of eligibility criteria being formed in terms of what can and cannot be used from a non-cash collateral point of view. Sorry, just 1 second. Excuse me, I needed a sip of water. Yeah, we need to look at what's sort of eligible. And then the second bit is, in our local market, there's a lot of activity happening in the corporate bond space, which is from a pure IB space, but not in the OTC derivative secondary market. But there's definitely opportunities in this level 1, level 2 from an HQLA point of view to sort of recycle your HQLAs in that form. The second thing is, in terms of non-cash, the market needs to understand or needs to sort of drive a process in terms of how are haircuts driven in this space. If it's 100% or 105% haircut, or sorry, 5% haircut or 10% haircut? Can it be in the same asset class, or can it be over multiple asset classes? Is substitution allowed? There's a whole lot of different scenarios that can be put in place, which can actually drive the optimization from both an asset manager side and a banking point of view, in terms of how we actually best optimize for this change in regulations. And then I think on the last, so you can change over to this next slide. The last point about non-cash collateral, which makes it very exciting, is this is being done now on a very, very massive scale in the international markets, where collateral upgrades and downgrades are being looked at from a yield play. So again, collateral, which is an operational process where there's a risk component to it, it becomes a there becomes a trading element to it, where you have a risk and a cash flow based on your margining process. But depending on the assets, you can sort of trade within these the set of collateral instruments you can trade. There's also yield pickup, which you can derive from that, and that's what the collateral upgrade downgrade trade talks to. An example of that is, we all know that your equities don't form part of your level 1 HQLAs. So what that actually implies is, I mean, from a return point of view, it should trade at a premium to your SAGBs, as an example. But from a mechanism point of view, what do you actually do to actually replace your equities for bonds in the collateral management space? So there's a lot of room for looking at innovative ways in our local market to work on that. And my last point on all of this is, and Ashley also touched on it, is in terms of the rate our local market is using for both pricing and discounting on our margin process, is the SAFEX rate. It always kind of, I mean, with due respect to however it was formulated, but it always blows my mind when we're using SAFEX as a benchmark rate. That's because trades are not priced on these, our discount curves are not priced on this. It's pretty much a rate that the listed market places their cash at SAFEX, which places the cash back into the banks, which is also not a regulated rate. So it's not your JIBAR kind of rate. And that's a rate being used on a margining process, which I find kind of not relevant for this market. In conclusion, I think as a market, there's a change in regs. There's a lot that's happening on a global scale, but I think as a local market, there's a lot more that can and should be done to be driving these reforms. A lot of work needs to be put in place in terms of how we actually modernize the market, for the lack of a better word. How do we start using technology, and how we actually start reporting based on the actual economics of a trade versus just purely following some sort of old regulation forms. So there's definitely a lot of work to be done. And I think from a bank point of view, this creates a whole lot of challenges which we need to work with, which will also help the asset manager side. Yeah, that's it for me. Thank you very much.
Thanks a lot, Ved. Yeah, that's certainly food for thought. Yeah, I mean, I think where we stand at the moment is SIMM is obviously coming, and I think we'll talk to what some participants' time horizons are just now. And I mean, I think it's very easy with these kind of complex new regulations to get lost in the detail, and to forget about the broader market dynamics and the structures that really need to be in place to make those regulations work effectively. And I mean, certainly that does seem to be, to a large extent, the view in the US. You know, I think a lot of the challenges that they seem to be having with repo currently seem to arise out of LCR and having to rethink aspects of that regulation. And, you know, I think we definitely need to just pause at crucial moments and have a think about what the dynamics at play in the local markets are, and assess whether the timing is right to actually be adopting these regulations, and to consider whether all the appropriate infrastructures are in place. Yeah. Thank you very much to Ved, Tony, and Jill. I think it's really been some insightful presentations, a lot of food for thought there. With the last 20 minutes, if we can just go over to Slido and have a look at the polls, and maybe we can talk through some of the content there, and I think also maybe answer some of your questions. So the first one I'm going to hit on is, will we have to wait for a CCP first to be established before SIMM model implemented? So Jill, I mean, I don't know if you want to talk to some elements of this. Certainly you alluded to it, but I mean, I think there's, so currently there are CCP options available in the form of kind of LCH as one of the primary options. Now, I think there are differing views in the market. Certainly some people, or certainly that seems to be sufficient from a bank perspective. But I know on both Ved and Jill's side, there are concerns about how appropriate the LCH solution is for some of the smaller players.
Yes, actually, I mean, the key problem with LCH is that they won't accept rand collateral, and asset managers are not in a position to post dollar collateral. I mean, that is really the major, you know, we can talk about all the capital requirements to be a South African participant in LCH, but the key thing is non-ZAR collateral. Yeah. So yes, we do need a South African CCP, or at least a CCP that can manage rand collateral.
Yeah. And I mean, I do think the important point that this hits on is really when the regulations were brought in, the intention was kind of a three-pillar approach with central clearing. And I mean, even I think if you look at the intention of the margining regulations, you know, one aspect is to make transactions safer, but another key aspect was to move trading towards central clearing venues. You know, so if we have SIMM and we don't have an effective local CCP solution, we're certainly missing part of the regulatory drive. So on the this SA derivative market, Ved, I don't know if you want to field that. I mean, certainly it would seem to me that the FX and interest rate derivatives make up a far more significant portion of the market than equities, but maybe you could comment.
Sorry, I'm just reading the question. So why are OTC equities not included, or all? Okay, no. So to answer that, there's a major amount of equity derivative flow that does happen on an OTC basis. I would actually, if I was a thumb suck kind of number, I would say it's at least 50% of your trade that actually happens on an OTC basis. And similarly, even on the between corporate and institutional business, your corporate activity will mainly go through on an OTC basis versus your institutional business, which will be between sort of exchange and OTC. So the OTC market in the equity derivative space is alive and very, very active. Yeah, so there is a lot going through without being crossed on the exchange.
Cool. And I mean, I think for both of you, just visibility on the regulatory timelines with respect to changes to enable a move to classic repo rather than buy-sell back. You know, I think that's a bit of an open question, but maybe you can give your individual views on that. And Jill, could we maybe start with you?
Okay, so, you know, that has been very much part of the discussion on the reforms of the Financial Markets Act in order to position that, you know, apart from the legislative framework, yeah, it could be done very, very speedily. That, you know, the plumbing is there. The plumbing is there. The regulations aren't.
So I mean, yeah, I don't know. I mean, it seems it hinges on a very specific piece of legislation that seems to be the contentious point.
Yeah, at this stage, and it certainly has been part of the, if you look at the document that came out last year, all the comments on proposed amendments to the Financial Markets Act, it's definitely in lights in that document.
Fed, I don't know if you have any comment.
So from a bank point of view, I think it's a case with all the big four banks. We are ready and all set up to do classic repos. We do trade repos into the international markets from a banking point of view. So I don't think it's any sort of technicality. So once the change in the reg actually takes place, it's business as usual. So it's not, there's no limit, there's no sort of restrictions in that.
Cool. And so this question around the trade repository, I mean, so almost one thing that this does spark for me, and I don't know if anyone has a view on this specific use case, but I mean, one of the things that has been interesting, I think, is to see the role that some of the technology solutions that have arisen to solve some of these problems can now play in the broader market context. So, I mean, I think for those of you who are familiar with like the disputes and reconciliation process, that CRIF file, so the Common Risk Interchange Format file, there's now a common way for banks to talk about risk. And I mean, even in terms of some of the validation and implementation of the FRTB regulations, that is now one of the ways that banks are looking to compare and discuss risk. So there's an implementation of a set of kind of common standards. There's reconciliation frameworks. I think there's a lot of visibility for kind of the large participants on exposures and who those exposures are against that arise out of those the reconciliation solutions through solutions like Tri-Resolve. So, I mean, it is kind of interesting, some of the broader infrastructure impacts that the regulations are having and the move that they are making towards making markets a bit more transparent. I don't know if either of you have a view on this particular use case as far as the trade repository and repo market reporting is concerned.
Yeah, I mean, it all makes sense because collateral and repo, they come like a cart and a horse. Yeah, so one trade repository, yes, it could piggyback on it for reporting.
I 100% agree with Jill on that, right? It's pretty much the same thing.
Cool. And then, so the question of local banks, so at least from a banking perspective, you know, it fits in with whatever other kind of regulatory regimes you are having to implement. There are certainly complexities, you know, so I mean, I do think there's a good sense to, well, yeah, so I mean, I think it's, if you follow a little bit of the ISDA discussions that are taking place, there are international challenges that are being felt in terms of these implementations. So there are definitely teething problems. Ved, I don't know if you have experience on this front that you can speak to, or how your implementation is going.
So I think from just, and I'm speaking, I think on behalf of all the banks, when there is ever a prescribed regulation change, the banks do everything in its power to ensure that it will be able to work within the parameters of the new rig. So it's a question of whenever a reg is enforced, the banks will actually act accordingly. So it's not a case of whether it's easy or not, it will be done. And I think that's kind of a long and short of that.
Yeah, but yeah. Sorry, I was going to make perhaps a non-relevant point. And then maybe I'm just going to jump rather to this question around tri-party repo and the potential amendment to GIMRA. Jill, do you have a view on that point?
Yes. Yeah, collateral transfer, you know, once again, it's legal versus accounting. Yeah, GIMRA is title transfer. And yes, we need collateral transfer. And I mean, that's what it covers. So, you know, within straight, you know, it gets flagged in different ways. But, you know, the key thing is it's not a sale from an accounting perspective. You don't de-recognize the asset. It's just reflected as collateral. So no, you don't need an amendment to the standard GIMRA. But I do defer to my legal counterparts. I think Andy Stewart knows much more about it than
So I was going to say, Andy, I don't know if you want to comment there.
I think Jill dealt with it very adequately. So thanks a lot, Ashley.
Sorry, it's you can remain a silent observer if you wish. And then on this LCH question, so I mean, if I read that correctly, I think what is being asked is just generally, is there news or is there any news regarding the implementation of a trade repository, not necessarily by LCH, but just generally speaking? And Ved, would you know anything? Certainly, to me, it seems to be the lower priority against the question of a local CCP.
So in terms of work done, the JSE is the only sort of counterpart that I know of that have been skirting around setting something up and looking at data. But other than that, haven't heard, there hasn't been noise around it. And I don't think LCH will work from a local context as well. I think, as John mentioned earlier, you need something that's specifically a RAND counterpart in our market. So yes, it does work if you're trading local versus international, and if you're trading multi-currency, and then it can be an avenue. But in a pure South African context, I think you will be complicating something that doesn't need to be complicated as much.
Yeah, 100%. Yeah. Look, I mean, I think that's one of the things that we keep coming back to is the need for an efficient and cost-effective local solution for central clearing. Yeah.
Yeah, so Ashley, I mean, it is a complicated discussion because, you know, as long as the banks are clearing through LCH with the international counterparts, then you don't get the benefit of netting between banks and their non-bank clients. But that's a reality. Unfortunately, you're not going to get non-banks migrating to managing non-ZAR collateral because of the way mandates are managed within the various funds. I mean, they do have approval to have offshore assets, but if you've got a domestic equity or domestic bond portfolio, you can't suddenly start posting dollar collateral because you haven't got a dollar mandate. So we're not going to win on that one.
Yeah, 100%. And I mean, I think it really does, Jill, I think you point to a very significant point just regarding the dynamics that are introduced by the central clearing landscape. I mean, I think as we talked to a bit earlier, the options that are on the table do have direct knock-on impact to the market. So I mean, I think this LCH CME spread for SOFA, I mean, that's kind of one of the more interesting examples. But the options that are available as far as clearing and as far as trading are concerned, actually have a direct impact on pricing in the market. So shall we just have a look at the poll results just to close off, and we'll see if there are any further questions. I see we've got 5 more minutes. Cool. So when do you expect your organization to be phased in? So I see limited number of respondents. I believe we're expecting most of the banks to implement this year. So it would be interesting to know who's out at 2024, but we won't ask you to raise your hand explicitly. Yeah, but I mean, obviously these regulations are coming. And I think from a regulatory standpoint, that's certainly something that can be addressed. But if we think about some of the broader infrastructures and those timelines, I mean, I think we're looking at challenges that do have a far longer lead time than pure bank regulatory compliance.
Yeah, and also the thresholds. I mean, actually, the 2021 is a 23 trillion threshold, and then it goes down until September 25 when it's 100 billion. So yeah, it's all in the size.
Yeah, 100%. I mean, I'd just be interested to know the nature of the players there, but certainly, I mean, I think we can gauge who might be involved. Cool, and then just onto the. Okay, so here, I mean, I think we're just talking really around the biggest operational challenges. And yeah, I mean, it seems to be evenly split. So, yeah, so Jill, Ved, I don't know if either of you want to comment here.
Looks like bank responses, so no.
Look, I mean, I think so. One of the things, this is, so these specific topics were taken from, okay, things are changing. This was taken from the, again, from one of the ISDA surveys. But I mean, I think here we're really looking at a lot of detail around SIM implementation specifically. And I think here, and this is kind of my tendency, but it's missing the bigger picture of what needs to happen from a market perspective, and hopefully this is a conversation that continues to happen and is heard where it needs to be heard. So, yeah, Jill, Ved, just if I could trouble you for some closing remarks, maybe Ved, if you want to go first.
Yeah, thank you to the team at Riskworx. Thank you very much to the audience. Yeah, I think it's a very interesting space we have because there's growth and development that can actually happen in the space. And it can only mean even more sort of flow from global funds into our local market, because as you sort of create more efficiency and sort of transparency into stuff, you will attract a lot more activity. So it's a step in the right direction for me. Thanks.
Yeah, and I think my closing remark would be that one should never underestimate the impact of cash drag on a portfolio performance. So the inefficiencies of posting cash collateral, can have a significant impact on the outcome of your actual fund performance, particularly when the yield curve is so positively sloped. And it really would make a lot of sense to be able to use securities within a fund rather than having to convert to cash. And that also, creates issues. I mean, think of what happened in March this year when we had the dash for cash. A lot, I wouldn't say that was completely driven by increases in margin calls, but it certainly was part of it, that you actually needed to liquidate assets in order to generate cash to post margin. So it would definitely deal with some of those issues in a stress scenario. And I haven't even started on the credit counterparty risk of having this cash exposure to banks. Not that one should be concerned about the big banks. I mean, they're highly creditworthy, but anyway, let me not go there. Thank you.
Yeah, no, thanks a lot, Jill. Thank you, Ved. Yeah, I mean, for me, I think, one of the big messages is we've got some very specific challenges that need to be addressed. But let's not lose sight of the big picture and, the ultimate impact on the markets. And yeah, I mean, I think thank you both for giving us fantastic perspective from each of your individual areas. And thank you everyone for your time and engagement.
Thanks very much. Thanks,
Thank you all. Thank you very much.
Bye.
Thank you.
Cheers.
Thank you.